and twisted his arm to move to Utah. So now Brian is a avid Utes fan. I just got to warn his brother and Brian, don't invite too many more people to come. We're trying to keep this place a secret. Brian serves as a controller for a local law firm. I said West because bigger and better things. He's in training to become a certified financial planner. And will sit for the exam sometime this year. Currently, he's began acquiring the license and made the transition to financial planner with New York Life, I guess, this fall. He also teaches, this is the beautiful part, teaches children's skiing up at Park City Mountain Resort. Tough job. He also serves on the board of the Greater Avenues Community Council, and now he's a Rotarian of Club 24.
All right. So I don't really teach skiing; it's more like babysitting. So, so I was given 3 today from Miami and London. It was quite the challenge, but I have skills. So I appreciate the introduction. Everybody had a great holiday season. To get back east to Pennsylvania and New Jersey, which is where I'm from, saw a ton of friends and family. It was really nice. Difficult getting back on the airplane to Utah, but it's the Salt Lake City groups like Club 24 that have this place. So I couldn't be more thrilled this morning to be pinned. I look forward to contributing to various songs. So thank you very much.
I'd like to invite Brett Sutherland, our president-elect, to introduce our distinguished speaker. Please welcome Brett.
You know, they say that in life, if you'd like to better yourself, that you see people who represent the qualities of representing your own life. John's a person for me. I consider him a friend now. I consider him I admire him tremendously. He's a person in the financial service in 2 years to get in here. So, and normally when I see John speak, it's on one of the coasts. He's highly who normally he transferred here 18 months ago into the new offices into the 111. He moved in yet? So he's in 111 now. He's a strategist with Goldman Sachs A, Strategic Advisory Solutions, where he leads the U.S. markets. The focus is on market insight, market strategy. He's been with Goldman for 16 years and is the managing director. He moved a family, Christy, and 3 children years ago. He is from, I haven't told you this now. For me, he's Gretzky of the financial services. Yeah, he does financial talk. He goes where he thinks it's going to be. So with that, Terry's a guest. We welcome you to contact.
Thank you very much. Wow, the warm reception everyone's receiving here. I feel inadequate in many ways to be talking to so many more. So I appreciate the opportunity. I've got 3 children, and they're sophomore in high school, and we live down in Draper. And whenever there's awkward silence, son will always come up and say, "The economy." Literally, you realize what keeps a roof over your head, right? And so it's just in our family, we even think that Dad does a job. I'm gonna go through a recap. We really have we need stuff to go 5 times. There's just too much to go through. Your time is too valuable. Some executive things and jump around some question, or you want to present, please, raise your as we go. Happy to amplify. I will easy to agree with. I will say some things. The only rule is just don't shout as you lie what I have to say. And frankly, you can even do that if you want. So thank you again, right? A pleasure to be here. 111 to Goldman, for me, is full circle. When I started graduate of Brigham Young, I worked for a manager called West One Trust, which was that building. And then I was fortunate enough for security investment management many years ago. Part of my skills running municipal bonds and spending a little bit of time in Boise, Idaho. 10 years ago, I had the opportunity to join Goldman. And in the 16 years I've been with, they love the Salt Lake office. They are the talent that they find in this community. Solved so many problems. And their commitment here is how quick can we continue this here? So I can tell you that, someone who considers Utah home but living in New York for 13 years, and what's taking place in this community and how work that gets done in this community, I don't think you fully how highly Goldman thinks of what's happening in their commitment to this location. What you're seeing is full of trends. 8 days of Goldman Sachs here in Salt Lake City. That job at Goldman gets them and then transfer to New York. Seeing people like myself and other saying, I like what's happening in Salt Lake, and you're seeing a lot of senior people make my career here in Salt Lake City. So the tension of talent that you start, it's all really driven by this community. I'm using myself to come back home. All right, so let's talk about me. We are, in short, a very glass type of view. We are realistic. We have some headwind, policy uncertainty, political uncertainty, particularly in a robust calendar, but at the fundamentals, the things that ultimately, what are the underpinnings for investing good? So what I'm gonna do is a lot of small things on this, say this, but just trust me. Trust me. We're not good at the top, but I'm just gonna pick spots that are important. I will talk about first, and then what we think they can market. And again, if you want to amplify, feel free to do so. All right, focus on not the number. The S&P 500 was up 13 per year. Dow Jones Industrial. The real story was the market post-election. Volatility in equities. It was volatility in interest rates. We had low should be higher, and the inflationary trend occurred. And the election and the outcome of the election and the anticipation of policy amplified that. So we've seen markets, but not where you normally see. Now the chart on the bottom is it is a policy uncertainty index. It's something that's becoming widely used. And really what the chart does is it measures the number of references in newspapers and in media, both digital and hard copy, of concerns about the economy and about the general state of the markets. And what we know is that we are at a point of elevated concern. And so that in and of itself is something we have to pay attention to. We think the fundamentals are in pretty good shape, but we know there's concern about the sustainability of the fundamentals. So it's just good to bear that in mind as we go through some of the data. All right, so let's talk about the world we know. The easiest thing is to look at the top line in the United States, and as you look at our GDP forecast, so these are growth forecasts. Most of us are used to a world where 3% GDP for the United States was considered optimal GDP, not too hot, not too cold. And that's where you wanted the economy. I will tell you that, and it's more of an academic argument, but because of demographic shifts and the decline in productivity, that 3 number is now about 1.8. 1.8 is the new level of what we call optimal GDP. So it's a little underwhelming, but technically that is trend optimal GDP for the US. So in 2016, slightly below trend, but we see a little bit of acceleration is our expectation of 2.3 and 2.2 in the United States into 2017 and 2018. The key point here is the risk we believe in our economy, believe it or not, is slightly to the upside because of the near-term impact for policy. The reality is consumers doing pretty well, housing is doing pretty well, but if you get to comprehensive tax reform, that can be helpful to the economy. If you get fiscal stimulus, that can be helpful to the economy. And there's a number of policies that the market's basically said, we think that might be an interesting transition and help amplify growth a little bit. But let's be realistic. At 2.3, that's still slow and steady growth. That is not explosive growth. That is not escape velocity. Believe it or not, our expansion is now 89 months old. Expansion only lasts 72 months. And so the fact is and I shouldn't have even brought that up. The reason I shouldn't have brought that up is because expansions in economies don't die of old age. And you're going to hear that in the media a lot. The second the markets turn volatile, they're going to say, well, we're kind of late stage in the economy. We're 89 months old. We're 90 months old as an expansion. We're due for a downturn. That is flawed economic logic. The reality is age doesn't cause recessions. It makes you more vulnerable, but the reality is bubbles, problems with the market, excesses in policy. That's where you get the problems with economies. And when we look at that, we actually think we're in pretty good shape in that regard. Now, when we look more broadly, Japan, Europe, UK, what we consider to be the developed markets, again, more of this slow, steady recovery. So when we describe growth, we basically call it resilient. The real story in growth is really happening outside the United States and developed markets, where you're finally starting to see a little bit of a recovery in emerging markets. Now, at the very bottom, if you get the bottom section, you see emerging markets 4.4, 5.3, and 5.4. That's about what you really want to hold for EM is about low fives. For the world, what we'd love to see is to get the world, the very bottom line, you'd love to see those numbers get to 4 to 4.2. So there's room for improvement, but the trends are absolutely in the right direction. Now I'm explaining some of the reasons why. This is just kind of a heat map. A lot of data. When you hear about GDP, you hear that reported on TV. The problem with GDP, and this is technical jargon I'm going to give you, it's chunky. It doesn't have a lot of inputs. It's very volatile. It's revised 3 times. What we use here is a more comprehensive view of the state of the economy. A deeper look, 31 factors that we see monthly, quarterly, some even weekly on the status of the economy. And basically the number on the right of that table tells you that piece of data is basically telling you the economy is growing at that level. What we want to see is a lot of green and a lot of yellow, which is what we see. We don't see, bright green, like again, not escape velocity, but when we look at the state of the consumer, when we look at the state of housing, what we're seeing is an economy that generally operating pretty well. This morning, in fact, we had ISM in manufacturing, a 2-year high in ISM. We've seen a nice little bounce back in the manufacturers as well. All right. The other way to think about the economy is from a financial conditions standpoint. Now, I'm giving you a lot of charts here. I'm going to try and bring them a little bit to life. Basically, this is the measure that if you think about Janet Yellen and the Fed, when they are looking at the world, this is going to be the first chart they look at every time they meet, 8 times a year, financial conditions. Because financial conditions has become the new metric that the Fed has been able to communicate their policy through. And what's financial conditions? Basically, financial conditions is a composite of the dollar, the stock market, interest rates, and credit spreads. And basically, what is their influence on financial instruments? Because that's the way that their policy is now getting communicated through the economy. When the line is moving up, financial conditions are tightening, meaning that it's becoming a little bit of a headwind, that the overall financial backdrop is becoming a bit of a headwind for the economy. When the line is declining, things are starting to ease. So you're going to hear a lot about financial conditions having eased over the last several quarters. That's what we're trying to focus on in the trend on the decline, even though we've had a little bit of a bump recently, the general decline in financial conditions. That makes policy and growth a little easier. Now, it happens with a lag. And so if you look at the chart on the bottom, we break it out by quarters and we basically say, how are financial conditions going to contribute to the economy? What you can see is in the first half, the last part of 2016 and the first part of 2017, financial conditions should be a tailwind to the economy, meaning that the increase in the stock market is generally offsetting the strength in the dollar. The tightening of credit spreads is generally offsetting the increase in interest rates, and on margin conditions are actually looser than they were several quarters ago. All right, I'm going to say a couple things that may feel political. They're not political, they're just economic. I'm going to hide behind that statement. Labor market. So the chart on the left is the U3, the unemployment rate that we're all familiar with. We will get this Friday a report. We think the unemployment rate will come out at 4.7. We are near full employment. It has been a slow grind. You can see that line coming down. The chart on the right is a very popular concept out there, and that's what we call U6. And U6 is an additional layer of unemployment that includes what we call the underemployed, the disenfranchised, the marginally attached, those who are discouraged. And early in the recovery, we knew that there was a lot of questions about the veracity of the state of the labor market, because we knew there was this huge chunk of underemployed, early retirements, disability, these factors that were kind of distorting the labor market. What I can tell you is a lot of those distortions are now out of the data. And so when you hear about infrastructure investment, or you hear about fiscal stimulus, and we're going to put 25 million people back into the labor force, the chart on the right would tell you, as it's declined, there's not 25 million people to put back into the labor force. And one of the challenges, it's a good policy and the market's going to respond well to infrastructure, but what we know is that when you apply a lot of infrastructure to an economy or to a labor force that is near full employment, you don't get as much growth and you get a little more inflation out of it, all things being equal. So the main takeaway from that is, as you think about interest rates, it shouldn't be surprising that all this talk of stimulus is having a different effect today than it would have had 5 years ago. 5 years ago, it would not have really moved interest rates all that much. Now, because it's potentially inflationary in light of the state of the labor market, we've seen interest rates move and move very quickly. Yes, sir.
Speak on this point on automation. As you get more, particularly in manufacturing, are we going to see more capital-intensive automation as production lines come back to the United States?
So I think the trend, clearly there is an incentive for, I mean, we're looking at global factors that are just amplifying and accelerating disruption. And so firm after firm, not just in manufacturing, but in every industry, financial services, my own industry, is being disrupted by technology and innovation. And there seems to be a very clear return on investment in doing so. In pure manufacturing, I think the challenge you have is, yes, that you're going to see more automation take place, but they want to see greater in demand before they really make that capital commitment. So for the most part, they've said, I'm going to hold on to my cash and I'm going to wait and make sure that in demand, aggregate demand is there before I really, tap into additional supply. Because the reality is we're pretty well balanced between supply and demand right now. That's one of the more efficient parts of the economy. If you see in demand show up, you'll see it show up in automation now. So I think it's more of an audible, decision. We'll see. All right. So the key point here is the labor market near full employment. The good outcome for that is if we think about inflation. This next slide here. That means that wages, which have been incredibly slow to recover, should start finally crawling out. We've been at about a 2% average growth in average hourly earnings for this recovery. Very, very shallow. Sorry, the chart moved on me. Okay, so operator error. All right, here we go. All right, so the main point is that chart on the left, it's a very long time period, so just look at the last inch of that chart, and what you can see is from the depths of the recession, we have seen a very slow rebound in average hourly earnings, but we're seeing it universally across all labor metrics. We should finally get to about 3 to 3.5% average hourly earnings. That's a place where a central bank is very likely to be comfortable raising interest rates. If they're starting to finally see all this data translate into earnings, that's when they're like, you know what, we have a self-sustaining recovery. And this is the way the Fed's been thinking about the world. The Fed and monetary policy is very much like my very first vehicle, which was a 1978 Datsun B210. And many people don't even know what a Datsun is. When I share this analogy with the analysts in New York, they don't know what a Datsun is, and they have no concept of what a manual transmission is. But this Datsun is monetary policy. I was the youngest in the family, and when it was time for me when I turned 16 on my birthday, did like every other 16-year-old, went to the DMV, got my license. My sister handed me the keys to the Datsun and said, "It's yours." She says, "I'll take you out and I will show you how to start this car." And I was like, "What do you mean, how do you start this car?" She said, "Well, let me show you the process. You turn the key on, put the clutch in, you pull it in second, and you put the emergency brake down." And then all of a sudden I realized why the Datsun was always parked on a hill. You start rolling down the hill, as we all know, pop that clutch, and the car would start. Right? So from our experience, what we know is when you pop a clutch too soon, you got your friends pushing on the back of a car, and you pop a clutch too soon, what happens? It's a very abrupt stop. And all that energy that was built up is evaporated back into the bodies of your friends. Right? It's physics.
That's pretty legit.
I know, right? So the point I want to make here about monetary policy is we're finally at the point where the Fed is incredibly conservative and saying, we do not want to pop the clutch because we're not convinced the private sector is ready for it. And if we pop the clutch too soon on the only economy in the globe that is truly functioning, and even just moderately at that, we're going to create some global problems. And so that's what, in our view, Janet Yellen and the Fed has really had a very strong risk management perspective. And we think that 2017 is one of the major transitions where they will become comfortable popping the clutch, because this room, this private sector here, has the capability to maintain the momentum. And that is a major shift, and it's been a long time in getting there. So ultimately, we think that translates into a little more inflation, the chart on the right, but clearly a Fed that becomes a little more active in raising interest rates. Now, it's interesting because what I show here is a chart that shows if you take all the tools that the central bank can use, so they can change reserve requirements, they can raise the discount rate, or they can do what we call open market operations. They can buy and sell assets and build a massive balance sheet. Of all the things the Fed can do, the dark line represents a composite of that policy. And so what you can see is that the composite shows, or excuse me, the lighter blue line shows that their policy has actually been tightening. The dark line shows the ECB by comparison, which is a good barometer for what's taking place with global central banks, which continue from their composite to be unbelievably accommodative. And then the space chart there just shows the delta, the difference between our central bank and other central banks. That difference between what our central bank's doing and other global central banks has massive implications on the markets, on currencies, on the short end of the curve, on interest rates, on how strong the dollar is. So we're going to watch this very carefully. What we forecast is that the Fed will raise interest rates somewhere between 2 and 3 times next year. Each time it will be 25 basis points. They will probably start in June. There has not been a forecast, someone at a podium in the last 7 years that has in January made that call right. This has been something that's taken much, much longer. We basically started almost every year with a forecast that the Fed's going to raise 2, 3, maybe 4 times. The Fed last year said, hey, we're going to do it 4 times. So take this with a little grain of salt. It is really as the data evolves, and there's always been a really interesting trend since 2008, which is for some reason, GDP growth disappears in the first quarter and kind of resets everything. So we expect 2 to 3, but this is really as the data evolves, and be happy to come back and give you updates as it takes place. But we do think this is finally that period where we do get a lift off. Now, look at this chart. I'm going to dedicate this chart to the artist Prince. Okay? And I would love it if someone who's very in tune with pop culture can tell me the name of the song. Okay. One of the challenges with this whole conversation about when the Fed raises interest rates is the market's pricing of it. So the dark line right here is 3-month T-bills. It's a very good proxy for when interest rates are going up and when they're going down and what the Fed policy is. And you can see on the far right, the dark line, we have been at effectively 0 for 8 years. All these hairs on the chart represent the forward market. The forward market's pricing of when the Fed is going to raise or lower interest rates. So if you look, for example, I don't know if we have a laser pointer on here. We do? All right, we'll have a laser pointer. Okay. So if you look all the way here in the 90s, for example, early 90s, the Fed is aggressively lowering interest rates. And what's the market saying? The market is saying, nope, Fed's done, rates are going to go up. Nope, here, Fed's done, rates are going to go up. And the entire process, the market, which we sometimes believe is clairvoyant, is completely wrong. The market's pricing a V-shaped recovery in rates, and the Fed delivered an L. And time again, when rates are going down, the Fed says, oh, we're done, we're going up. Nope, we're done, we're going up. And how long have we been talking about higher interest rates in the last 8 years? I've been having this conversation since 2010. The Fed's going to raise right around the corner. So what I just explained is not even the point of the chart. It's just interesting that the market misses when the Fed's raising interest rates. What's probably more interesting is when rates are going up. If you look at when rates are going up, all of a sudden those gray lines start to dip below the dark blue line, meaning that the market doesn't believe it. And the Fed chronically raises interest rates faster than the market believes. That's why when you manage your fixed income, you have to be recognizing that the market is not clairvoyant and consistently underprices the trend in rates. We think that that's, a very likely outcome this time as well. It just tells you that for your safest asset, your bonds, you still have to be really thoughtful about how you're managing those, and the market's not the best proxy. All right, now it's a little ambiguous, but does anyone want to venture to guess what the name of the Prince song is for this chart?
When doves cry.
When Doves Cry. Thank you. Sometimes people give me 1999, I'm like, what? When Doves Cry. All right. Now, if you don't get it, tap someone on your side and they'll explain. All right, so I've got 5 minutes. So let's just talk about markets. Housing, generally okay. The key takeaway here, the dark line is above the light blue line, meaning that households are forming faster than we're building houses. So even though the housing market has had a nice recovery, home builder index is doing pretty well, single family home starts are up 20% year over year, believe it or not, there's still room to go. It'll slow down a bit because we've had an 80 basis point increase in mortgage rates, but at the end of the day, as long as the light blue line is below, or gray line is below the dark blue line, we're not building enough homes for household formation. So our kids are either getting married or divorced faster, and we're not getting homes fast enough. So that trend is going to play out. All right. Yes, sir.
Can you just comment on the growing preference for renting versus buying for some of these younger households that are forming?
It just messes up the data. Here's what I will tell you. These millennials are just killing economic data because they're not acting the way they should. And here's our last hope. Our last hope is this. What we know is in the data, when you go through economic cycles, when you have the hard times, the 18, the 28-year-olds and 32-year-olds tend to be hit the hardest. And so this cohort in this recession has been pummeled. And so there's been a lot of living at home, a lot of living at the basements, and there's been a lot of preference for reorganization and living locally where the services can be found. It's a cheaper way of living, and it's a more fulfilling way of living for that generation. But what we do know is this, that there's something in the data that says every generation is a little bit different until you hit 35. And at 35, something clicks in the data that says, I gotta get a job. This year, 2017, is when a massive cohort of people who are messing up my job turn 35. And we're really hoping that we see this normalization back to home buying. I can't answer the question, but there's probably a few people in the room that we should ask why they don't want to own a home.
Is there a benefit for millennials to get a job before 35?
Absolutely. No doubt about it.
Here's your 2 million.
All right. Okay. I wish we had some. We haven't even done the fun stuff. All right. Let's all this macro stuff we discussed. Let's just bottom line it right here on the chart. Bars on the left. What's our probability of a recession? The light blue line shows 24%. Okay. Given the normal cyclical tendencies of our economy, there is a 24% just walking down the street that will be in a recession within a year. There's just that's the normal probability of a 1 in 5, 1 in 4 chance that we end up in a recession. What is not understood is, I bet if I asked you before I started, are we closer today to a recession than we were a year ago? Most of you would have said closer. Maybe not after the election, because there has been some bounce in some of the data. But what I want to let you know is all of these conversations we've had, the probability right now of a recession is 21. Actually, to update the chart, it's 19 now. Now it's just a model, but the key takeaway I just want you to think about is our recession risk is below long-term average. The fundamentals, while it doesn't necessarily get captured in the media, are pretty robust. And the risk for a downturn in the next 12 months is lower than average. All right, I'll talk stocks for a second, and then I need to get off the stage, don't you think? Mm-hmm. Yes, okay, I heard a definitive yes. Okay, what is Tom Petty's best album?
Henry.
Come on. This is easy. Tom Petty's best album.
The greatest hits.
Oh, that's a good response. All right. It is commonly accepted that after the greatest hits album, his next best album is Damn the Torpedoes. All right. Does anyone know what the etymology is of the statement Damn the Torpedoes? Where that comes from? Full speed ahead. Admiral Farragut, Civil War. This is great. What is it? All right. So I'm going to loosely explain this story. There's a battle. It's the Bay of Mobile, and it's the last port that's open for the South. And so the North knows that it is vital to complete the blockade and close the Bay of Mobile. The South knows for supply reasons they've got to keep this port open. So there's a massive battle getting ready to unfold at the Bay of Mobile. Admiral Farragut is heading the fleet, and he knows that the South has heavily mined the opening to the bay with those mines that are tethered to the seafloor just below the sea's surface. Those back then, those are called torpedoes, not mines, but torpedoes. And so Admiral Farragut decides that there is he's going to be very aggressive, and he's going to basically blitz. He has superior resources, and he knows there's going to be collateral damage, and he's going to aggressively attack the South. So like any good admiral, he has a ship in front of his as he starts the attack. So the ship going in, you can help clarify that. I don't know if you talk about naval battles at West Point. That might be taboo. Okay, all right. So, all right. But the ship in front of Admiral Farragut sinks, hits a torpedo, sinks right in front of the fleet. And so the captains of the other ships, as part of the attack, peel off the attack. And Admiral Farragut says to the communications of the rest of the fleet, "Where are you going?" And the captains communicate back, "Admiral, what about all these torpedoes?" And this is where this famous war cry comes from. Damn the torpedoes, full speed ahead. And it became this war cry because there are times in battle, like there are times in investing, where unbridled risk-taking is the right strategy. This is not one of them. We are now at a point. All right, really quick, 2 minutes, and I'll be done.
I think we're going to give him a little more time.
Oh, you don't want to give me time, because I'll take it. All right. So I want to just make a point. When you look at the valuation of the stock market, sorry, I've just got a little delay between my finger hits. And all right, so the chart on the left measures the valuation, the forward PE of global markets. So that little bar on the left that has a 17, that basically is the forward PE, the price for earnings of the stock market. We are at the upper range of valuation. Frankly, we're above this now. So we can't really make more because the prices of things are going to go up. We're in a market where, if you look at the chart on the right, that is a measurement of the PE. And the only time we've been higher than the current valuation we are today is the tech bubble. Okay? So this is a market where it's really difficult to just make money on the price, repricing your stocks. If you look at the chart on the left, and it's a really simple chart, if you decompose the returns of the stock market into its key components, if you look at 2013, the chart on the left, you can see the market was up in 2013, 32%. Of that 32, 2% came from dividends. What's that number? Is that 11 from earnings?
Yeah.
And 19 from multiple expansion. When you have a good, big, green part of your bar, that's the PE multiple, right? That moving. That's the rising tide floating all boats. That is a damn the torpedoes. In 2013, what do you buy? Anything. Your worst idea is just fine. When you get to where we are in 2017 and you look at the potential composition of returns, the answer, when I ask you, should you buy stocks? The answer is yes. But you need to be careful because that green bar is now negative, meaning that instead of getting paid for exposure, you're going to get charged for exposure. Being a little more selective is really important in how you invest your money. Balance sheets We're seeing the highest leverage on balance sheets that we've seen since 2007. Now their ability to pay their debt bills is still pretty good. Interest coverage ratio is pretty good. But the reality is the rising tide can't float everybody's boat because everybody's boat's in a little bit different condition right now. So the key point here is we think you're gonna make money in stocks, 5 to 7%. But you can't just own things in a blanket way. You've got to be a little more prescriptive about how you're investing. Let me pause because there's so many areas I could go, and I've used them all the time. Any last questions or thoughts or rebuttals? Yes, ma'am.
My question is your first and second slide, and we have economic growth, and I think it showed Russia as negative and then going up. What is the factor behind
the recovery in Russia? Okay, so if you go back to the original slides, we showed a couple emerging markets. Oh, that's a really good slide. I should have gone through with you.
Please go.
No, all right, I'm going to crystallize this point one more time about equities, but on the Russia issue, it's not actually that the positive number is a shift of improvement. It's the negative number reflects the collapse of energy prices and the reliance on energy and the impact of sanctions. Now, in about a month, there's a revote for sanctions against Russia, and the energy market is improved 48% in 2017 or 16. So it's really the punitive nature of oil and sanctions was showing up in 2015, 2016. They're slightly just crawling out of that because of better energy prices. That's all it is. Russia is an energy economy every bit the same as Saudi Arabia is, frankly. All right, last point I want to talk about this equity market to set your expectations. This is the S&P 500 right here. And to kind of bring this all full circle, we do believe you're going to make money, but you're in a transition from what we call a tall and thin market to a fat and flat market, okay? The tall and thin, if you follow it, this was a little bit animated, but if you see this line that shows up, that is tall. That is an example of a market where the slope of your returns, very steep, very positive. That is a market we call tall because your PE multiple, as we talked about in 2013, is expanding. It's also a thin market because the range of outcomes has been very narrow. We went 1,400 days without a 10% correction in the market. You typically have a 10% correction in the stock market every 258 days. We went 1,400. Oh, these are the things I want to talk about. All right. This is the market we were in. Starting August of 2015, the Chinese devalued their renminbi. We got a 10% correction in the market. We believe we've entered a new period of volatility. The slope of your returns is going to flatten out a little bit. You're still going to make money in equities, but the rate of return is not going to be dominated by multiple expansion. It's going to be dominated by earnings. At the end of the day, if your company's going to earn about 5 or 6%, we think that's what your stock's going to return. No more free money. But the range of outcomes, much, much wider. So it's going to take more intestinal fortitude, more stamina to stay in these markets. You're going to get more volatility for less returns. It will be worth it, but only for the patient, disciplined investor. All right, now I say that, the patient, disciplined investor, because I want to talk about this last point on volatility. It's a little bit of a did you know. And then I swear, Brett, I will stop as I've got to know. Okay. Last concept from an investment standpoint, and I'm trying to get there, just have a little delay, is going to be talking about volatility. This one, right, here we go. Very important concept. If you look at the returns of the S&P 500 since 1990, I show you the calendar year returns. Of the 26 observations, so 21 of those bars are positive. So I like those odds. As an equity investor, 21 out of 26 years, I made money in stocks. The point I want to focus on are these little triangles. So I want to look at those 21 years. So if you look at those 21 positive bars, and then you look at the little triangles, the little triangles show you the maximum year-to-date loss of any calendar year. The point being is if you look at the 21 positive years, 19 of those positive years had negative returns at some point during the year. you were negative, you were year-to-date negative. Think of last year. Last year was the worst start in the stock market in many, many years. We were down almost 10%. If you bailed out on the stock market on February 11th, you missed a very robust recovery, 23% returns by the end of the year. 19 of 21 times you have positive returns, you're in negative territory, calling your advisor saying, what is going on? Losing money is almost the most predictable part of making money. And if you get spooked when the market starts negative, go to the fundamentals. Go to the fundamentals and understand where things, sometimes you got to get out because things are changing. Other times it's just the market sentiment that's being a little bit, changing on you. So just understand that losses are a frequent part of making money. And it's that patient investor, we think particularly in 2017, that would be positioned to do reasonable. All right, have a wonderful 2017. Thank you for the opportunity to be here. Happy to come back and give you updates anytime you want.